Now, on behalf of Chairman Brown, let me recognize Senator Rounds.
Thank you, Mr. Chair. Vice Chair Barr, welcome back to the committee and congratulations on your confirmation. In recent speeches, you've announced that you would be conducting a holistic review of the capital framework for our financial institutions. Included in that evaluation will be a review of the supplementary leverage ratio, or SLR, the countercyclical capital buffer, and stress testing. This review is long overdue, as the Fed has said for months that it would reassess both the GSIB surcharge and the SLR. In the process, it is important that we strike a balance between financial stability and economic growth. In order to achieve that balance, I believe the Federal Reserve must be transparent and consider input not only from Congress, but from stakeholders on any adjustments. When do you expect this review to be complete, and will you commit to providing a transparent, formal, public process with a comment period for any resulting adjustments to SLR, the GSIB surcharge, stress tests, or countercyclical capital buffer?
Thank you, Senator Rounds. We're conducting that review now. We're in the middle of that. I expect that early next year we'll be able to say more about where we are in that process. If any of these parts of the review require us to rethink a rule like the ESLR, the countercyclical capital buffer, and the like, we would, of course, seek public comment as part of that process. We will issue a proposal, get comments in, evaluate those comments, understand them, and then lead to any action we took on a final rule. So we would follow a normal process on that.
Thank you. Chair Harper, late last year, the NCUA approved its 2022-2026 draft strategic plan, which included an analysis of the internal and external environment impacting NCUA and evaluated the agency's programs and risks. It included language suggesting that as a result of changing weather disproportionately affecting farming communities, credit unions should consider adjustments to their membership. This was very problematic language, as it implied that credit unions that primarily serve agricultural communities may have to alter their memberships or face increased costs and regulations. As a result of the actions of Senator Cramer and myself, that language, thankfully, was not included in the final draft. Chair Harper, will you commit to avoiding similar problematic language in future strategic plans and commit to not punishing credit unions for supporting their local farmers, ranchers, and agribusinesses in their communities?
Yes.
Thank you. It has been widely reported that the CFPB is planning to shift liability for peer-to-peer payments that consumers make to a scammer. Scammers would likely profit from such a policy because, armed with an official government document, they will be able to induce people to pay them by telling them there is no risk in sending the money, even if the circumstances are suspicious. However, banks, unlike the consumer, would have no insight into the transaction to be able to stop it. My question for Vice Chair Barr: are you concerned there will be an impact on bank safety and soundness given banks' inability to identify or stop the fraud and the size of potential fraud losses banks could incur? And furthermore, has there been any research done to determine how fees would increase and what new costs consumers would bear if this is implemented?
Thank you, Senator Rounds. The regulations at issue, Regulation E, are implemented by the Consumer Financial Protection Bureau. So in the first instance, I think it makes sense for them to figure out what they would like to propose, if anything, in that area, and then we'd be able to understand the implications of that proposal more broadly. But I don't have any further insight about it at this time.
No existing studies at this point.
I don't know the answer to that. None that I'm aware of, but there may be others that exist that I don't know of.
Thank you. Following an influx of deposits generated by government stimulus, the FDIC approved an aggressive proposal to uniformly increase bank deposit insurance assessment rates by 2 basis points until the Deposit Insurance Fund reaches a designated reserve ratio of 2%. This proposal has the potential to disproportionately harm community banks by forcing them to pay between 5% and 25% of their pre-tax income for insurance assessments. Meanwhile, the OCC recently approved a 40% reduction in assessments for OCC-chartered community banks. Acting Chair Greenberg, could you please explain your logic behind supporting increases to community banks' FDIC deposit insurance assessment rates well beyond the statutory requirement? And was a study done to determine the ratio of 2%, or is that an arbitrary number?
The 2% was the subject of careful analysis and was reached based on the FDIC's experience during two crises. And just to be clear, if I could take a moment to explain, because it's a little complicated, under the statutory requirement, there's a minimum reserve ratio for our deposit insurance fund of 1.35%. And if that ratio falls below, the FDIC is required by law to establish a restoration plan to bring it back up to the 1.35% minimum. As you noted, at the beginning of the pandemic, there was an inflow of insured deposits, and it pushed the ratio down. And the FDIC, back in 2020, adopted a restoration plan that did not envision increasing assessment rates. And we expected, that was based on an expectation, frankly, that as, frankly, the pandemic progressed, the growth in insured deposits would slow down. And what occurred is that over the past year, from the second quarter of this year to the previous, the insured deposit growth rate remained very high at 4.3%. So we had projections that envisioned us being able to restore the reserve ratio fund to the statutory minimum by the statutory deadline of 2028. We thought we could do that without an assessment adjustment. Because the growth rate stayed high, it shifted our projections and really put in question whether we could get to the minimum in time. So we had a tricky call to make, and I'll just be candid. We could have delayed and hoped that the growth in insured deposits would slow down and the problem would take care of itself. The problem there, and I'll come quickly to a conclusion, was that if we were wrong, we then might have to impose a larger assessment on the industry at a later stage of the cycle when the industry would be in a not in as good a position to absorb it. So we opted for a 2 basis point increase. That's about 1.2% of industry income. We did not envision that impacting lending or credit availability, but it would assure us of putting the fund in a solid position, particularly since we're heading into an uncertain period. So it was a tricky call, but that was the judgment we made.
Thank you, Mr. Chairman.